They put the guardrails on this FHA program, which could single-handedly take down this market. This is going to be uglier than most people think. They're underwater. They're getting hit with property taxes, insurance, at the same time their cost of funds to keep that Ponzi scheme going. We have seen unprecedented intervention. So many people took forbearances during COVID. We have the highest folks working 2 jobs that we've ever seen. After 2008, the banks really stepped back out of the mortgage market. You only have to have 3.5% down. That share of the market right now is around 13%, which is about the share of what subprime was the last time things started falling apart. I think the banks want them out of mortgage. There's going to be a cycle where they've brought everybody in they can possibly bring in, but it is a Ponzi. It's a drug and it becomes very addictive. These were middle-class people that were coming and moving. Ultimately, they're being priced out. So even if rates go lower, you're not going to have a lot of people who are going to be able to qualify. We had the lowest first-time home buyers on record last year. 15.6 million boomers are going to age out between now and 2035, and they own the majority of homes. We had all this built for rent. All of the homes were empty. And I was just like, what is going on? A lot of them look like army barracks. It's all luxury. It's like everybody forgot who lives in this country. We might see a bailout in the form of Fannie and Freddie, a government agency buying back the homes from private equity. By privatizing, I think that the Fannie and Freddie would suicide themselves. Being a landlord is not going to be cool. It's not cool. But whatever they try to do to help the boomers is going to crush the younger generations.
Melody Wright, welcome to the show. Thank you for joining me.
Well, thank you so much for having me. It's my pleasure.
Well, as I was saying before we hit record, I was on Michael Ferris's show, Coffee and Mike, last week, and after our conversation off the record, he said you have to reach out to Melody. I was telling him I'm in the market to buy a house where I live in the Northeast in the Philadelphia area, and you've been on his show. I've, since my conversation with Michael, watched a few of the podcasts that you've been on in recent months, and I think this is a conversation that I'm not only going to get value out of, but we have a lot of millennials,
yes,
Gen Xers in the audience who are probably in a similar position than I am. So I'm really happy to jump in and talk about the real estate market with you.
Awesome. Looking forward to it.
Yeah. And like I said, I wanted to open with a chart. You come with a bunch of quantitative, hard data, something I like to follow, not only in real estate, but just generally is Google Trends. And if we look at Google Trends right now, particularly for the search help with mortgage, we are at, we have reached March 2009 levels.
Yeah. Yes, indeed. This is not surprising at all. And, you know, what's crazy about this, though, Marty, is if you think about it, we have seen unprecedented intervention already and loan modifications and workouts that, you know, so many people took forbearances during COVID. And once those forbearances were over, you know, you could go up to 18 months of not making payments. You had to have some sort of workout to deal with those forborne payments. And so what many people did was a payment deferral if you had a Fannie or Freddie loan, or a partial claim if you had an FHA. And they put it at the back of the loan to be paid off when you sell the home or pay off the mortgage. And then many people did modifications as well, reducing their payment. So this is quite shocking because we've had intervention that far outweighs what we saw after the last housing crisis. And yet people need help with their mortgage.
And what is driving this specifically? You think it's the labor market, people becoming unemployed, not being able to afford it? Is it mainly homeowners who got committed to adjustable rate mortgages, and with the mortgage rate being above 6%, their payments just became too much? Is a combination of things?
It's a combination of things. But you know, a lot of it is, yes, the labor market is weak. You know, we have kind of the highest folks working 2 jobs, and those are part-time jobs right now, that we've ever seen. And so, you know, I think the labor market has been weak for some time, but people got into mortgages they couldn't afford. What a lot of people don't understand about this market is that after 2008, the banks really stepped back out of the mortgage market. This was because of Basel III requirements, the supplementary leverage ratio, things like that. And the non-banks stepped in, but they did, they're funded basically by the government-sponsored enterprises and agencies. And so what you have now is a largely government market. And the FHA program specifically kind of stepped in where private was last time with subprime. People getting mortgages with credit scores of 580 if you have a big down payment, for instance. You only have to have 3.5% down. And so that share of the market right now is around 13%, which is about the share of what subprime was the last time things started falling apart. And so people just simply can't afford it. And something I said years ago is that we wouldn't even have to have a deteriorating labor market to see a crisis, because property taxes and insurance have risen so much that people simply, they were already taking out too much leverage that they really couldn't afford, based on these loans they were getting from these government agencies. But then you tack on property taxes and insurance. And I've seen, your mortgage servicer pays those, and they put it into your payment. And I've seen escrow notices go out saying, we're sorry. Well, they don't even really say we're sorry, but, hey, your payment has just increased. It's just doubled because if you're in California, for instance, because of that insurance increase after the fires and property taxes. So I think it's just a real affordability crisis at this point.
Yeah. Property taxes are interesting. They've been a topic of conversation the last couple of podcasts, particularly after Ron DeSantis started on his campaign trail of eliminating property taxes in Florida specifically. And I think, I forget who it was, but basically described property taxes as unrealized cap gains taxes that are really pushing people out of the market. And I imagine they are affecting the boomers the most in retirement age. They thought they had their nest egg in their retirement accounts. They're looking at their average mortgage payment and they say, okay, we need to hit this level. We can sustain these payments and buy food and go on trips and whatever. And then you see inflation across the board and the triple whammy, I guess, with property taxes going up as well.
Yep. When I was in Miami in July of 2023, there was actually seniors stormed a condo administration building because they got notices that their HOA fees were going up. And this is, I think this is what the whole country has forgotten. Places like Las Vegas, Florida, here in East Tennessee, Gatlinburg, is that these were middle-class people that were coming and moving. And, they weren't the super rich, right? Californians. And ultimately, they're being priced out. So this was it was in Pembroke Pines, a very middle class or even blue collar big condo development. And they just got a notice, hey, your property tax, your HOA fees are going up like $500 because of insurance and different things like that. And they stormed, the police had to be called, like an old man was pushed to the ground. It was terrible. I mean, so what you've seen since then is inventory just fly onto the market in Florida.
And I think that's a big question, is what's going to give first? Is it going to be mortgage rates or the prices of these homes? Because I think that's what, again, putting my millennial prospective home buyer hat on, I'm looking at the prices of the houses in my area. I'm like, they're not, they've dropped a bit. They certainly haven't risen in the last 6 to 8 months, but they're still relatively elevated, especially when you factor in the mortgage costs. And I've been saying on this show, it's two parts of the equation of housing affordability, of the cost of the house and the mortgage. And if rates aren't going to fall, we need to see the people that currently own the houses just stomach the fact that they're going to have to sell them at a lower cost than they expected.
Correct. And even if rates do go lower, Marty, it's not going to be enough to really juice the housing market again. And so I think that, because of those existing lower interest rates, and for rates to really go lower, you would have to have the Fed buying mortgage-backed securities again, or somebody buying mortgage-backed securities again. That could be one of the things on the table, is Fannie Mae and Freddie Mac doing that. And so that's the only way those rates go lower. But even then, I can remember 2010, that was everybody's great hope, as that rates would go low and they could refi. And we did have a mini refi boom back then, but it did not stop home prices from correcting. And I feel that because of where we are, the other thing you asked about affordability, but also people can't access credit right now. You know, what's happened with those student loans now that they're reporting, and this is important, of course, for your millennial and even Gen X, I had them, you know, is now that those are credit reporting, we've seen massive impacts to credit scores, you know, and the Fed had a study in February where almost 42% of mortgage refinance applications were rejected. I mean, that was the highest they'd ever seen in their series. And so people can't access credit anymore. Klarna, you know, these places that are now reporting, or I think it's actually only a firm that's now reporting to credit. But now that they're reporting to credit, they can't do buy now, pay later anymore. And so the doors are just closing all around. And so even if rates go lower, you're not going to have a lot of people who are going to be able to qualify. And the fact of the matter is we had the lowest first-time home buyers on record last year since they started tracking in the 80s. And I think a lot of people fundamentally misunderstand this housing market. It's about investment and speculation and not really home buyers. And such, you got to think about what's going to happen in a speculative environment.
Yeah, well, that's a great point to bring up, considering the fact that this is a Bitcoin podcast. I'd love to get your thoughts on this and sort of thrusting this on you, because we didn't talk about it in prep. But that's one of my strong beliefs, is that the fact that real estate has become this store of value asset and investment vehicle that individuals and institutions use to attempt to outpace inflation, when one can make a strong argument that real estate is not really fine-tuned for a store of value asset. It's a consumable good, and
it's a depreciating asset.
It's a depreciating asset. And one of my big thesis, and many Bitcoiners' thesis, is that you're going to see a value leak in terms of from real estate to Bitcoin as people begin to wake up that you don't need to use your house as a savings vehicle. You can use this digital scarce asset in Bitcoin, which has far superior properties in the fact that it's scarce, divisible. You can send it over the internet, has no maintenance costs, no property taxes. And that's, seems to me, over the course of many decades moving forward, that it's going to become obvious to people. But I think right now, the big problem is, again, going back to the boomers, is that this is what they were taught their whole lives and their whole careers growing up, is like, you get a job, you funnel it into real estate and financial assets, and you're going to be good. But we've gotten to this cross point societally where it just doesn't work, because you're driving this affordability crisis, which is getting out of hand. You mentioned the new home buyers number being the lowest on record last year, but then you also have like the median age of a homeowner or a new homeowner, even with it being its lowest point in history, the median age was 56.
It's insanity. And so, you know, what's happening right now, people don't understand. I mean, there's so much data you need to look at when you're looking at the housing market. And most people look at like two factors, you know, inventory and price, and that's it. But what people don't understand is that, you know, the municipalities got drunk on the American Rescue Act money. Like they got all this, they were infused with money. And so they did all kinds of programs like, you know, down payment assistance programs, housing affordability programs, but they got used to it, and they didn't think, oh, how are we going to reproduce this? You know, as I was taught when I was little, money doesn't grow on trees, right? But they just kept spending and spending. And so unfortunately, people are going to think, well, home prices are going to come down. Maybe my property taxes are. In reality, those municipalities are going to be after you. And so I think this whole Florida DeSantis thing is kind of funny. Let's see where it ends up, because you look at somewhere like Boston, who, because they have lost tax revenue from commercial real estate, they are putting that bill out to homeowners. And that's crazy. And so unfortunately, I think that this is going to be uglier than most people think. And those property taxes are really going to weigh in that leakage that you're talking about. Because if you think about a house that costs that much to maintain, then that value, that's not, the value just continues to erode.
Yeah. And how much of you mentioned institutional buyers, how much of an effect do they have on the market? Because I've seen headlines and data coming out that like the Blackstones and BlackRocks, Berkshire Hathaways of the world have been buying up single family real estate or multifamily real estate to use it as an investment vehicle, buy it, rent it out. It seems like they're underwater on a lot of the properties across the country.
They are. And it's people, this is a huge debate of how big are they really? What's the percentage? But it really, you don't even need to aggregate percentage. It's just it matters locally, like in San Antonio, Atlanta, these places where they did go big. You're definitely seeing prices fall much faster because they're underwater. They don't have a homestead exemption. So they're getting hit with property taxes, insurance, at the same time their cost of funds for the borrowings that they have to keep that Ponzi scheme going are higher and higher. And so they're underwater and they're selling. What they did in 23 and 24, a lot of what they did was trade amongst themselves so that they could sell it off to like American Home for Rent would buy some of Lennar's new builds neighborhood. But at that price, they could turn around and refinance and get more borrowings. And so they were kind of all in the family trading so that they could continue to access credit. But we're hitting the point now where they're going to have to distress sell. And you're seeing it has massive impact on neighborhoods. And you don't even know usually if you have one of these next to you.
Sup, freaks? This rip of TFTC was brought to you by our good friends at Bitkey. Bitkey makes Bitcoin easy to use and hard to lose. It is a hardware wallet that natively embeds into a 2 or 3 multi-sig. You have one key on the hardware wallet, one key on your mobile device, and Block stores a key in the cloud for you. This is an incredible hardware device for your friends and family, or maybe yourself, who have Bitcoin on exchanges and have for a long time, but haven't taken the step to self-custody because they're worried about the complications of setting up a private public key pair, securing that seed phrase, setting up a PIN, setting up a passphrase. Again, Bitkey makes it easy to use, hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a Bitkey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20.
Over 10,000 investors downloaded the original How to Position for the Bitcoin Boom when Bitcoin was just 27K, and it called for 120K plus. That target's now hit. So what's next? Tur de Meester is back with the 2025 edition, refreshed for the mid-cycle moment, packed with new data, new insights, and Tur's latest price outlook. Plus, you'll get exclusive access to Charting Our Way Through Chaos, Tur's new 30-minute Q3 2025 presentation explaining why this bull run might be only just beginning and what forces could push it to the next level. Read the first ever mid-cycle report from Adamant Research at unchained.com/TFTC. That's unchained.com/TFTC. And also, if you're using Unchained, you can use the code TFTC for $50 off any of their services. Go check it out. And that's the other thing, too, because I'm sure, I know you've heard this because I was just listening to a podcast this morning you did with Adam Taggart recently where you mentioned it. But I think to set up this part of the conversation, there's, I'm sure you're aware of the All In podcast. Jason Calacanis, David Freeberg, David Sachs, Chamath, Paul Papatia. I've been like beating the proverbial desk on X every time they talk about the real estate market because they're like, we just need more supply. We need deregulation. We need to take the federal lands and just build housing on federal lands. We need more supply. And it's just abundantly clear to me that that's not the solution to this problem. No. If anything, you're going to exacerbate it and you're going to end up building low quality housing that really doesn't have any value at the end of the day, particularly in the long run. And it is mind boggling to me that, some in the financial cognoscenti really can't see that the problem, to me, seems like a financial engineering problem where, right. Again, going back to we're using housing as a savings vehicle and more supply is not going to solve the problem. Right.
No. And in fact, I will take them on a tour if they would like to go see what I have seen on the road. And everybody, here's the thing about permits. They think that they can track this by the permits. Well, they can't. Number one, we've seen reduced participation in those surveys, and that's how you find out how many permits. It's a survey. And then secondly, in unincorporated areas and places around me, Tennessee, Texas, you don't have to file permits. And so if I took people to see what I have seen, Marty, there is no way. And that low quality you talk about, it's already out there. And it was as if they were building army barracks, Marty. I mean, all over Florida, Texas, Tennessee. It's actually insane. how much inventory is out there. Raleigh, outside of Raleigh, North Carolina, I mean, all over the country. And so I'd love to take them on a tour to show them all of the supply as well as all the vacancy all over this country. There's vacancy because we've had a lot of foreign buyers use the market for money laundering or just, parking their cash there. But a lot of it is money laundering. And so there's just a misunderstanding of what's going on out there because most people can't wrap their heads around the fact that this became a casino. And how it happened is essentially they saw Wall Street buy up those homes at the end of the last crisis. I was there at the auctions and the banks were just begging them, please, because it's not profitable to foreclose no matter what anybody says, just the way the machine works. And so the banks were begging, they came in and bought them. And then everybody got hooked on that whole idea of fixing and flipping, renting out a house. I mean, it was a national obsession, but for whatever reason, people just can't admit that that's what's happening. I have if you listen to that podcast, you know that I asked Adam this question. It's like, most people think the average household size in the United States is around 3 or 4. In reality, it's at like 2.5. And that's because of all of the second homes and all of the investment that's happened. And, I have a friend who says, do we really want to get down to one house per person? I mean, is that what we want American life to be? But there's just a huge misunderstanding of what's happened in real estate. And and I don't know, sometimes it feels willful, that actually they do understand what's happening. So who knows?
Yeah. Well, let's expand on your offer to take anyone on a tour, because from what I understand, this is part of what's opened your eyes. You literally traveled around the country to see this. And I mean, you alluded to the experience, but let's expand on that experience. What drove you to get in the car, hop on planes, and travel the country?
Like one morning Bloomberg edition just in January of 23 just infuriated me because they were talking about the housing market was coming back. And I was like, are you guys on crack? Like, how could you And at the time I was looking all around, looking at all the analysts that, I had previously followed, people like Ivy Zellman, who kind of called, was Poison Ivy last time, who called it. She was talking about demographics at the time. She was one of the only ones. But people just were putting all of the pieces together. They weren't putting that, we're, as Harvard says, 15.6 million boomers are going to age out between now and 2035, and they own the majority of homes. People weren't putting together that we had all this built for rent, single family residence, like you were just talking, being built for rent. All this new home development, all this multifamily. And so, I also come from mortgage credit. And so I also understood there just wasn't enough people out there that could afford. So I read this article and just decided at that moment, I had no pre-plans of this, that I was going to get in my car and I was going to go to Austin. But I stopped in Nashville, was my very first city on the way. And I got to Austin, and I mean, I will never forget standing in my first mega site in Austin and just going, I was physically nauseous, Marty. I was just like, what is happening? This can't be happening again. Because as someone who lived through the last crisis, I swore up and down. We swore as an industry this would never happen again. We would never. The builders swore this would never happen again. Lennar got a tax bailout last time, and swore it would never happen again. And they were swearing on earnings calls they weren't doing it. And I was standing in that mega. And what is a mega site? People might not know. It's where all the builders build in the same site. And so you have like Toll Brothers, Ryan Homes, regional builders, and they just have this massive development, and they were just building up into the hills, but all the homes were empty. And I was just like, what is going on? And then I saw that over and over, all over the country. Florida it's depressing, Marty. I mean, again, a lot of them look like army barracks, and it was insane. And that's because I track data religiously, 85 markets. I look at them every week, but you have to, at some point, you have to get out and go look for yourself and that's what I tell people, just take a left turn on your commute instead of a right, and you will see what I'm talking about.
That's funny. You bring up Austin, because I just moved back to the Philadelphia area where I was born and raised, from Austin. We did a 4-year stint in Austin, moved there in 2021 when the real estate market was screaming. And we luckily, and I like to think very smartly, decided to rent. And we rented the whole 4 years
Very
we were there.
smart.
And our rent never went up. And I think that was because right after 21, things started cooling off. And it's not only on the residential side. We were in South Austin. If you look north to downtown, there was, I think,
all the multifamily. There
was 10 trains in the sky the whole 4 years that we lived there. And you talk about that's one thing I worry about my commercial real estate friends in Austin specifically, is because there's a ton of inventory coming on market, both in residential and commercial real estate.
I used to rank a city on how many cranes they'd have. They call it like 5 crane city. Even though Austin, I would argue there were probably like 30 cranes when I was there. I often wonder, where are the cranes going to go to die? These are usually individual operators, a lot of them. And so Nashville was the same. Nashville, I think, was the first to really get started. They started really around 2018. But yeah, it was that multifamily. And this is the thing, Marty, it's all luxury. It's like everybody forgot who lives in this country. And I think that this, because we saw wages going up, for that brief moment. And it was like, oh, we're all getting rich. We're all going to be rich. We're all going to get fairly paid and life is going to be golden. And because you had a handful, this is what's so funny. You had a handful of Californians and people like this move into certain areas, and people are like, they're all moving to my city and then built for that Californian. Well, the fact is there's a limited number of those Californians that are going to come, and this luxury, nobody can afford. And Austin has the vacancy in multifamily there is just staggering because they all built these luxury high rises in downtown that are empty.
Yeah. Luxury, and then they had the California white boxes that they were building. We were in the Zilker Park neighborhood, and there was a California box style house that sat for sale.
The black houses. Did you see those? And all? I was like, "What is this? This is what was that?"
It's not really aesthetically pleasing either.
It's not. And then I saw what's that movie series, Despicable Me? Is he the one? Yeah, he has the black house. I was like, is this what this is? Like, it made no sense. But anyway, okay.
Building for Gru. You don't want to do that. As a father of young children, very familiar with the Despicable Me series.
That's right.
I'm not sure if you're a fan of urbanism or like Chuck Marone's strong towns concept, but that's something that I pay very much attention to. And it's the reason why we moved to the section of the Philadelphia area that we did, is because you have houses that are literally 100 years old that were built well. And
I love that.
I think that's one thing that really disheartens me in today's day and age, is literally taught to get on the hamster wheel of competing with and outpacing inflation. And that just leads to completely misaligned incentives in terms of the quality of builds and what you're getting to market at the end of the day. And I think that's going to be a massive problem that we have to deal with decades from now. It's like during these periods of the mega sites that you're mentioning, what are we going to do when nobody buys these houses? And
we bulldozed it last time. We bulldozed it in the 30s. Like, we'll bulldoze it. I mean, there's a book called Swamp Peddlers, also another book called Bubble in the Sun about Florida. They take you through this history. This is something that happens over and over. And there's a picture of a guy on a bulldozer in a subdivision from back, in the 30s. And so, and now what was crazy for me, because I did manage default at the end of the last crisis and spent most of my time in Florida. And I would go and look, and they were building on the same subdivision that had been bulldozed before. I mean, that was just like, that is when I knew, in the middle of Florida, flooding everywhere, low cell service, 21 of these mega sites. I was just like, whoa, that's Lakewood Ranch. That will go down in history, and not a good way. And so that's what we're going to have to do. And I often say I'm bullish bulldozers, although John Deere's having a little bit of trouble right now. So, but.
What's up, freaks? This rip was brought to you by our good friends at Obscura. Obscura is the first VPN that can't log your activity by design. Instead of empty promises, Obscura fully embraces the Bitcoiner don't trust, verify mantra. They can't log your traffic, even if they tried. Obscura believes that user data is toxic waste. In addition to private payments via Lightning, you can sign up with an account without having to give any personal identifying information. It's a beautiful thing. It's the VPN I use every day. It's incredibly fast. You can go on streaming sites with it. They don't say, hey, you've got a VPN. It just works. So go to obscura.net. Use the code TFTC25 for 25% off an annual subscription. Obscura.net. Use the code TFTC25 for 25% off an annual subscription. What's up, freaks? This rip of TFTC was brought to you by our good friends at Silent. Silent creates the best military-grade Faraday apparel for your everyday life or in Bitcoin. Hardware. Securing your hardware in Bitcoin is very important. You want to make sure you're not leaking any signals, Bluetooth, RFID, NFC. Make sure you get Silent apparel. It has patented technology that makes it impossible for those signals to leak. I've got the crossbody bag here. I keep my phone in it when I want to unplug and make sure I'm not being tracked by big tech and potentially the government. Easy in and out. They've also got a wallet that I've been using as my daily driver. I was using Ridge Wallet for a while for the RFID blockers. That is very thick and was big and hefty in the pocket. Now I have the Silent card holder, which acts as a wallet essentially. They've got these great sleeves for hardware wallet protection. If you want to make sure that you're not leaking any of those signals, NFC, accused NFC compatible, don't want to leak it, just want to be double sure, protect it from EMFs, put it in the bag. Go to SLNT.com/TFTC to get 15% off any and all the products on their store. Important to note, Silent is also a company with a Bitcoin treasury. They accept Bitcoin for payment. So if you're on a Bitcoin standard and you're looking for military grade Faraday protection for your everyday life, go to SLNT.com/TFTC. You'll get 15% off.
That's got so good question. As you described earlier, it seems like the dynamics of the debt markets, the credit markets, and real estate are different than they were in 2008 with the banks sort of fading real estate due to reserve requirements and Basel III. What's the other one? Oxley. What's the first word there?
Oh, socks.
Yeah,
Sarbanes-Oxley.
Sarbanes-Oxley.
Oh,
yes.
never forget socks. Yes. Most of my mid-30s. Yeah.
Yeah. So how do you think this deleveraging plays out, and how does it differentiate from 2008 if it is upon us?
Oh, I think that private equity, private credit, like this is one big mess, and it's going to be ugly. I have a theory, and this is I often think way into the future, Marty, and I'll lose a lot of people that way. But I have a theory: we might see a bailout in the form of Fannie and Freddie, a government agency buying back the homes from private equity, because under the ruse, it will be a ruse. Under the ruse of affordable housing, because these guys are so over their skis. And the banks are exposed here as well because they've lent to these private credit. And it's just like what we're just now seeing with Tricolor, this subprime auto dealer that, just blew up, claims of fraud. And we're seeing Fifth Third had to make a huge write down, almost 10% of their existing reserves. So, this is for one loan, guys, one loan. So if you're not paying attention, you need to pay attention to this Tricolor start, because it's going to be ironic. So my company was originally owned by my former company by GM back during the crisis. Okay. So we were very closely aligned with our auto partners. We were the mortgage arm. And, back then it was all, you bad mortgage people. How could you ever, get us in this position? And then of course we got TARP money, and it became Ally Bank, who guess what they've done in auto? They went whole hog into subprime. And so it's for someone who is, in a corporate culture where we were the redheaded stepchild, like this is actually kind of funny, but they're impacted. And so I think auto is going to be the first place we see the fires. And then it's going to have a contagion effect. But the ABS is in bad shape. Again, it's the same thing. It's like people have been sharing the meme of Georgia from The Big Short. She's got the dark glasses and at S&P, I think it's S&P. They don't, they're asleep at the wheel or, they actually know and they just don't care.
Well, that's, it's interesting you bring that up because as I mentioned before we hit record, just had our third child. So we're very, very conservative with household finances as Bitcoiners. We save in Bitcoin. We try to spend way less than we make. But we had to upsize, and get a second car due to the fact that we need a third row now, which is a good thing. But the financing of the car was very interesting. I have a very good credit score, and I got ping ponged around by different financiers and had to pay. I'm paying a crazy rate on it that I'm hoping to refi at some point next year.
That's wild.
Yeah.
Really?
Yeah.
Oh, so that tells you what's happening.
Yeah. Like me knowing, sort of following what's happening, I'm like, oh wow, they're really desperate for yield here.
Yeah. Yeah. And but that's how these games go, like auto origination, mortgage origination. Like they always forget there's going to be a cycle where they've brought everybody in they can possibly bring in. And then, but it is a Ponzi. You need the way the securitization markets work. It's a drug. You need that gain on sale. You need that to originate that loan so you can sell it into the capital markets and get that hit. And it becomes very addictive. And when you get in these down cycles, they simply cannot cover their cost of funds. Like they can't, and so that is very telling, actually, Marty. Thank you for sharing that with me. I could feel it, I could see it, but that's wow. So yeah, I think let's watch auto. I think that is, it behaved rather well during the last crisis because people they chose their house they chose their car over their houses because they needed to get to work. But this time around, I think because of all this crazy lending, we could really see fires in auto and it could cause quite a disruption in the credit markets.
Yeah. Since you mentioned the Fannie Freddie potential bailout theory, to just buy up the houses from these credit funds and PE firms, using the guise of housing affordability. It seems like if there are sort of, if there's an order of operations to this, on the front order of operations beginning to signal to the market as an administration that this is what you want to do. And it seems like Scott Bessent, Bill Pulte, and Donald Trump have explicitly been more explicit in recent months about housing affordability.
Housing emergency. Mm-hmm.
Yes. A housing crisis, a housing emergency. Mm-hmm. And there's much talk about the Trump administration spinning out Fannie Mae and Freddie Mac as a private company to sort of allow them to get out of the Obama era bailout and feeding their profits into the federal government.
I have a theory on that as well.
Let's hear it.
I think the banks want this. I think the banks want them out of mortgage. They really, the banks really. Mortgage is a great product when it's working well, and you can make there's not much you can make this much money on. And because of those requirements, they had to scale back. And I can tell you that nobody wanted to be a government lender because the red tape, all of it's crazy. And then they always, Marty, find a way to make you pay. It's never as good as like, oh, your FHA loan is fully backed. Oh, no, it's not. I've never seen one claim, like a full claim payout. And I manage a claims department because they will nickel and dime you. They'll also charge you fees for things that you can't control. They'll also make you repurchase loans. Anyway, working with them is a nightmare. So I have a theory that the banks want them out. By privatizing, I think that Fannie and Freddie would suicide themselves. And so I think that this could be actually one of those things where on the surface, it looks like one thing, but it's really about another. And I'll tell you why I believe this. So recently, our Congress somehow passed the trigger ban. I mean, they can't do anything else. Trigger lead ban. What is this? This is where when you go to get credit for a mortgage, the credit agencies will sell that you just got a hard pull for credit to all of these non-bank originators. And they'll buy, so those non-banks will buy up those leads, and then they'll call you, and you will get, like, if you do this, you will get hammered. Okay. And so essentially this is very beneficial to the non-banks out of nowhere. And I talked to a lot of people in the industry. I was like, did you see this coming? And typically when you get some type of legislation in mortgage, the Mortgage Bankers Association, they're at the front lines, everybody was taken by surprise that now you cannot, they've done a trigger lead ban, and this benefits the banks. And it benefits companies that do own, both their origination and servicing. But in reality, I think it benefits the banks the most. And it's a way to start pushing out the non-banks again. So I think there's more afoot here than what's being, than all the noise around this. And it's funny, you heard that the banks came down to talk to Trump about this privatization plan. And that's partly, I think, as well, why they got the SLR, why they've been lobbying hard to get that those requirements reduced.
Sup, freaks? Guess what? We launched a browser extension. It's called Opportunity Cost, and it helps you see the true cost of everything in Bitcoin, convert prices to Bitcoin as you browse the web. Opportunity Cost automatically displays fiat prices in Bitcoin or sats, helping you think in a Bitcoin standard. It works on Amazon, Zillow, X, your bank account, QuickBooks. You can convert everything to Bitcoin. It's really cool. It's also 100% open source, MIT license. We don't collect any data. All of the conversions happen in your browser on your local device. It's a great way to recalibrate your life and begin thinking in sats. Go check it out at opportunitycost.app. That's opportunitycost.app.
That's very, very interesting times, because I have a lot of conversations on this show with analysts with their very different theses about where we're going. And I think the predominant thesis that's been expressed on the show over the last month is that we're going to get lower rates. The Trump administration is going to do anything they can to make sure that the market keeps screaming and it's all systems go moving forward, which I could definitely see happening. But then you look at all this anecdotal data, like the chart I showed to open the episode, you look at delinquency rates, the amount of credit card debt that exists, where stocks are trading their PE levels at .com historic highs, and it's just like you squint at the situation. It's like, okay, how can they really continue doing this without first saving the middle class or making life better for the middle class, more affordable for the middle class.
Right. And I think the train has left the station. And what I've been trying to tell people is, like, you've got to really somehow figure out how to reduce the noise and look at the real signals. And it's increasingly hard to tell what is a real signal, especially when they're screaming about the national emergency on housing. But Basent did a very interesting op-ed that not many people talked about. It was really weird in the Wall Street Journal. And everything that I've seen action-wise, action, not words, out of this administration is they may perform some sort of bailout or whatever, but they're leaving it alone. And, they put the guardrails on this FHA program, which could single-handedly take down this market, actually. And so maybe they don't understand what they did. But so my former CEO, or actually he wasn't a CEO at the time, he was a boss of mine at my former company, is the CFO at Freddie Mac. And he was the only one left standing, because you remember Pulte went in there and just cut everybody out. And I have to believe that he understands. And immediately following that, Fannie and Freddie took Fannie took a $900 million, almost $1 billion in provision for loan loss. And so I think there is awareness, and I think there will be some performance. But right now, it feels as if they're going to let this thing loose. They're going to let it go. So we'll see. You have to keep, again, it's kind of like we also heard from them in April, Main Street over Wall Street. And then we got a few stock market losses, and you could tell, it was like, the big freak out. And so you never know. Once we get into the situation, they might put the brakes on, but what will probably happen is the state AGs will get involved, especially if we get into another foreclosure crisis, to slow it down.
What do you think is the best path forward? Do you think we just need to take the hard medicine of stomaching this deleveraging and let it fall back to prices that are probably more representative of what these properties are actually worth? Is it as existential as we were made to believe it was in 2008, where the housing market is a cornerstone of the American economy, and you simply can't let it fall, so you have to come in and bail out at all cost? As somebody who's been through a couple of these cycles now, at least, what do you think is the best course of action, despite what may or may not happen?
If we don't give our younger generation something to hope for soon, Marty, I don't think anybody's going to want to live in this country. I mean, I think it is somewhat, so I think it's existential in the other way. Like, right. It's like we had to save, the housing market last time, the boomers. I mean, and I don't like getting into the generational wars or whatever, but, I think this time around, if we don't give our younger generation something to hope for, we're going to see more of what we have been seeing. And it's just the nihilism, the depression, the deaths of despair. Like, I think we're reaching a point where we have to have young people who can dream again, dream about the things that really are important to us as Americans. And so I think they need to let it. I think housing has to become boring again. And, this happened before the Great Depression as well. Everybody was a landlord. Everybody thought that was the way to get rich. And then you suddenly realize, oh my gosh, I'm getting phone calls at midnight on Friday. I don't have a weekend anymore. My property tax and insurance are going through the roof. I can't find tenants who can pay. Like, if I'm in California, I can't evict them, or New York or whatever. And so I think that the landlord class, and you kind of mentioned this earlier in the show, there's now house coin. And I often get people, I've got a huge crypto community now that kind of every time I post something negative about housing, they come in, saying many of the things that you said. And so I think this is taking hold. And I think the reason this sentiment changed is with these natural disasters that we had last year, with Helene, with Milton, with the fires, that it changed. That was in huge areas where people had gone in bigly for Airbnbs, short-term rentals. And all of a sudden, overnight, you have this massive nightmare and losses. And, the Palisades, I mean, that destruction was insane. And so I think the sentiment has been changing for some time, but being a landlord is not going to be cool. It's not cool. And so I think that housing could become boring again if they stop intervening. And they can continue to try, Marty. I mean, they're going to try something, right? But I think that we've reached the point that whatever they try to do to help the boomers is going to crush the younger generations. And I think I think that some of our recent events that have occurred, we can see how much anger is really out there. And we're going to have to contend with that. And when people talk about UBI or things like that, I just look at them and say, who's going to be giving out the houses? Because that person is probably, they're going to need a significant security detail. And in fact, it won't be enough, so there's just, I think everybody's saying lower rates. Well, okay, that's up to the bond market. What has been is not necessarily going to be so, for the past 40 years. And I think, okay, well, you've got a globally synchronized economy that so many are facing some sort of trouble. People are going to have to get tribal. They're going to have to defend their currencies. They're going to have to do things. And it might mean selling off the 10-year, and we won't get the lower rates. Basent's been saying that since December, and we have not gotten there. And so we can't get below 4. Like you and I were just talking. I was like, oh, where's the 10-year? Are we below 4 yet? We haven't gotten there. We might get there. But will we stay there? I'm not sure.
No. And I think that's the collective market has amnesia in terms of this idea that if you lower the Fed funds rate, the 10 and 30 year will follow. Because
It
literally
did last year.
exactly a year ago.
Yeah, exactly a year ago. Like, are we all this silly? I mean, I don't understand. So it's like this time, I mean, Marty, for 3 years, because really, honest to God, it's been 5 years. It's just my entire industry. It's like, rates are going to go so low, and then when we got the hikes, people just couldn't believe it. And that's all they've been selling for the last 3 years, so it's crazy.
Yeah. No, to your point about the existential crisis being in the other direction this time around, that's my biggest worry too, is if you think about who are the largest donors, who are the most politically active, who is the most representative in the political class, it's the boomers. And so if we do get to the precipice of, or if and when we do get to the precipice of a real estate and broader economic crisis, I do fear, just not even fear, it's just like, what is the most likely outcome? If you're looking at incentives, it's the people funding the campaigns who are the most politically active and from an age perspective, most representative in Congress and the Senate. It's probably most likely that they're going to get another bailout.
I think they're going to try, but I don't know if you follow Russell Napier at all. But
I do.
Yeah. And I think that, what I have learned from Russell and just talking to other people, it's like, think about what they have to do versus what they, want to do. And at some point, Marty, they've gotten rid of a lot of the SNAP benefits through the BBB, Medicare. They've done what they can to the lower and middle class. They're going to have to go where the money is. And the money is not, in the middle class anymore. And it's not in the lower class. And they're squeezing that as much as possible. And so I think you're right. They're going to try everything they possibly can. But I just don't think it's going to work this time. They're going to, ultimately, we're going to have to go where the money is.
Yeah. It's a crazy time to be alive.
It really is.
Because I'm just thinking through it, because I don't know, even if we do have an asset price deflation and correction, the amount of money that's going to need to be printed in reaction is going to be inflationary, and just to think that people living off of retirement can continue to subsist on that sustainably is very hard to believe. And
Right.
I think we put ourselves in a rock and a hard place again. Bitcoin podcast, I think this is all derived from the money itself and the corruption of how money works and the cost of money by manipulating interest rates. And I think part of the solution is not going to be mechanical in terms of the different policy decisions and where you decide to inject liquidity. I think it's going to be philosophical and more human, where I think there's going to have to be a moment where individuals realize hey, my parents are retired. They're not going to be able to live off their retirement. We may need to get back to multi-generational housing instead of the son living in their parents' basements, the parent hopefully living in the child's home. And
I moved my mom in with me a year and a half ago. And before that, I had just considered buying her house. It just didn't make sense. It's like, okay. And, Gen X, I'm a Gen Xer. Gen Xers were so independent. We're so individual, and so the idea of it was just insane. But in reality, I just looked at the money and I was like, this is not, and also knowing, I was studying macro at the time and thinking, no, we need to batten down the hatches. And because I think the worst thing you can be in right now is in debt. I mean, I think that those that are in debt are just going to get crushed by those higher interest rates on credit cards. It's just, I always say no to debt slavery, because in these hard times, those are the people that just get absolutely crushed. So, but yeah, it's already happening. We saw household formation slow last year. People are consolidating. Some of the most active construction projects are adding on your mother-in-law apartment or an ADU on your property. But like you say, it's going to shift. It's going to be the kids that have to take the parents in, because the boomers are the largest increase to the homeless population right now. Now, of course, they're the largest group of people, but still not every boomer is rich. Many of them got wiped out during the GFC, and don't have savings. In fact, my family got wiped out during our last bout of inflation. We lost my home to foreclosure when I was 9, and a part of my family never recovered. And I think this is what happens in these huge cycles: is you kind of take out massive swaths of the population that just you take away their future, their financial freedom, and their future to be able to be in a position to have enough money to live.
Yeah. Want to get your thoughts on potential solution. Selfishly, because outside of this show, I'm a managing partner at a fund that invests in Bitcoin infrastructure. It's called 1031. And we've invested and actually entered in a joint venture with a company called Battery Finance. They spun out a New Market Capital, which is a traditional structured credit fund, with their founder and CEO, Andrew Hones, and their CIO really caught the Bitcoin bug in 2020, and they're looking out at this problem that we're describing today, particularly with a focus on commercial real estate right now, but ambitions to get into residential real estate, and saying we've got a mismatch in terms of the quality of the assets that are sitting within these structured credit products and the reality of the economy. And so what they're doing is combining Bitcoin and these assets to try to make it easier to underwrite from a credit perspective, because you have sort of uncorrelated, highly liquid, fungible collateral sitting alongside the real estate. And so they underwrote their first project last year here in Philadelphia. Actually, it's commercial real estate, multi-purpose building down in Center City, Philadelphia, and they basically refied. I believe it was a $12.5 million loan. 9 was used to pay off the existing mortgage. 2 was set aside to do repairs and maintenance and upgrades to the property, and then 1 to 1.5, I believe, was used to buy Bitcoin to sit in the loan structure, with the idea that this is a 10-year loan. We'll offer you a lower rate and maybe a longer amortization schedule. But we're going to both participate in the upside of the Bitcoin. And the bet they're taking is, hey, we're going to de-risk our exposure to this real estate by adding Bitcoin to the collateral package. And we're backing Battery and very confident and passionate about it, because I think when you're looking out at the world and you're thinking of ways to fix this problem, I think you have to get creative and bold. I think this is a bold, creative solution. And one of the big memes in the last 5 years was the soft landing that the Fed and the Treasury have been trying to manufacture. And I don't think they can manufacture it. I think you need to begin to wean people off of real estate as a savings vehicle by introducing what should actually be the savings vehicle to these credit structures.
Right. Yeah. I mean, solutions, I think we have to, I would love if they just let the market, they'd leave it alone. And we did actually get the GSEs out of, or at least a reduced presence. But I think that the solutions lie within us, Marty, and that we have to start caring locally again. And I think I love that you actually are investing where you live, and I think this is important because we don't, like you say, all the Congress folks are bought and paid for, right? And they're also of an age that they don't have a lot in common with us. And so, but we can't do anything about that, really. I mean, we can vote, of course, but they're all bought and paid for. And so what I say is we have to vote with our dollars, and we can't, spend stupid money on stupid things. And we have to start caring locally. Like, you have to start caring. Like, if people had cared in Austin, that city council sold them down the river. I mean, like, just sold them out. And so that's where I think the solutions start is let's do city planning again. Let's sit down and talk about these empty buildings as a community. What are we going to do about it? Perhaps there are people that do, like you, that want to come in and invest and help us revitalize our neighborhood, take back our cities from these speculators, because that's the other thing. None of these speculators live in these cities, Marty. I mean, they're either overseas, or they're in California or New York. And so they're not living there. They have no allegiance. And so in reality, what I'd love to see is government gets out of housing altogether. And that, I think the market will take hold, because supply, people are going to be so surprised by the amount of supply we're going to see in the next 5 years. And so the supply is going to drown out any other narrative or anything like that. And so I just wish we could actually sit down and talk about it so that we could come up with solutions. But I think it has to start local.
Yeah, I completely agree with that. And again, I mentioned it earlier, but have you read Strong Towns by Charles Marone, Chuck Marone?
I haven't. I don't think I've read the book. Don't they have a newsletter?
They have a newsletter.
Okay, yeah, I get that. Yeah.
They have an initiative. I believe they just did something with Pensacola or some town down in Florida. But I've anybody who's listened to this podcast for long enough is like, Marty, why are you mentioning Strong Towns again? Because I'm passionate about it, and because I think Chuck is really tuned into what makes a strong town, and it is really focusing locally.
I'll read that.
And most importantly, like the metric that he hones in on for like a local economy is revenue per square foot for the small businesses. So like utilizing the space, that wasted space that you're describing. And I think it's actually something we do well here in Philadelphia. At least we did to a certain point. I just moved back, so I haven't been paying as much attention. But my cousin worked for the Horticultural Society for a long time. And it was probably about 10 years ago. But in the summer, they would go to vacant lots and activate them, like have food trucks and stand-up beer gardens, and really get people invigorating, and most importantly, monetizing those spaces was what we need much more of small businesses. And that's the great shame of particularly the political reaction and the policy reaction to COVID specifically. It just decimated small businesses in the middle class. And
it's so depressing. And Marty, when you drive as much as I do across the country, it's heart wrenching. It is just, we are not living in the America that we remember. And our cities have just, I've seen people OD in front of me, like in San Antonio. I recently went out to California to Skid Row. I thought I was in South Africa. I thought I was in Cape Town. It was insane. And this is all over the country, every downtown, even my little city, Johnson City, Tennessee, this little city in the mountains, kind of like Asheville, is full of homeless people. They come here for the Veterans Hospital, but it's one of the best in the country. It's just, we are not living in the country we remember. And so many of us really don't get outside of our little circle and don't understand that. And that's why I just think we have to, I'm so passionate about people just talking. We have to be able to talk to each other. And even if we don't agree on anything, we have to be able to talk about what's best for our communities and our families. And I think most of us share a lot of the same ideals, but a lot of what's programmed out there, the bots, want us to be yelling at each other. And so I just feel like we have to get back to that small town type understanding, our culture, where we can recognize and appreciate difference, but it's not everything we talk about. Like we just talk, like it's just tolerance. Like we all love each other because we're working for the same thing. We want to provide our families a future. We want to provide, our kids hope. And so, a lot of that in America is that dream of home ownership. And so I just feel we, as a nation, we have just completely let sort of social media take us apart. And we just have to start fighting back, in my opinion, and getting involved locally and doing things probably nobody wants to do. Talk to other people. You have to talk to other people.
Agreed. It's incredibly ironic because the state of discourse that you're describing is just feeding the negative feedback loop. And the state of discourse is driven by the problems, the underlying systemic problems that exist. So people, no matter if they're red or blue or MAGA or Democratic Socialist, whatever it is, like they're suffering from the same systemic economic problems that have very unique and specific problems at their core. And the discourse is just driving a wedge between everybody and exacerbating those problems, because you find that you actually never talk about solutions with other people. And
ever.
Yeah.
ever. It's been what's most frustrating to me is that I just kept thinking like a dodo bird, like we would get to that point. Like people would be more aware by now because they would just drive and look and see what's happening. And that we could start talking about solutions. And I mean, we're not there yet. I mean, it does feel like, though, things have started to accelerate recently. I often talk about, because, people say, oh, you've been saying this for 2 years. I've been saying what the path is, like where we're headed. And basically, I say we've either sped up or we've slowed down. And this summer, we started to speed up again. And actually, we're at September 16th today. That FHA program gets its guardrails at the end of this month, starting in October. And it will take time. This is not something that's overnight, but this is going to have a massive impact on the housing market. And most people are not paying attention. I was on site at a very large mortgage servicer 2 weeks ago, and they said, Melody, you're the only client that started talking about this. We just had one other person bring it up. But I was like, I mean, I was screaming when I found out about it, because this is going to double their work almost overnight. And so most people, though, in the industry that are left in the industry don't remember what happened last time. They have they don't understand default. And so the whole industry is asleep as well. So, I mean, it's, this is going, like you say, these are very interesting times. And the people that say like they've got the script and they know exactly what's going to happen, I call total BS. I mean, I think we are in the Wild West right now. And people just want to believe they understand what's about to happen. But I think we are living in the moment, Marty, right now. And it's going to be kind of crazy.
Yeah. And could we just reiterate what those FHA guardrails are specifically?
Sure. Yeah. So this program was crazy. And there was a recent Wall Street Journal article. So it kind of got exposed in April because of a Wall Street Journal article. But it was nuts. So basically what the Biden administration did is, back during the after the crisis, we had to re-underwrite you if you were going to get a loan modification. We actually cared. Could you actually pay this modification if we give it to you? If we modify your note? And some people could not. And so we did not give them a modification. But what happened this time around, because of COVID and the stress of COVID, people didn't have to send in financials anymore. In fact, they didn't even have to call their mortgage servicer to be put on a forbearance. You just automatically kept getting put on it. And so then that wasn't enough, Marty. We saw in June of 23 people going into delinquency in the FHA, and the administration knew that there was going to be an election, and that was just not. They couldn't have it. And so they came up with this partial claim supplement modification where you essentially could go and say, you know what, I can't pay. I didn't pay for 3 months. And they say, no problem. Let me take those 3 months, put it at the back of your loan. And then you didn't pay for 3 more months. And then you just went back again. And then you went back again. I have a colleague who he dives into the mortgage-backed security data, and it has these partial claims. And the partial claims, if you've had one, you are 5 to 7 more times more likely to go into default again. So these things are not, they're just that you keep going back to the till. And in fact, you've got whole rings of originators that know this, and they tell investors, hey, you don't even have to pay your mortgage for 12 months. Like, don't even. So go get this mortgage, go into early payment default. You'll be able to get this partial claim. And so, I mean, this is insanity. And so what they did, many of us in the industry lobbied against this, is they put guardrails on that you can only get one of these every 24 months. People could go back. You could take out up to 30% of your unpaid principal balance. 30%. That is insanity. Well, now you can only do this every 2 months. You also have to pay trial payments to be eligible. Now, what is that? This is every workout. You have to pay at least 3 payments. So they know it's skin in the game. This is something we understood back then. You have to have some skin. So you have to make those 3 successful payments now, starting in October. That was not even a requirement before. And then the other big thing that people don't get is if you have delinquent student loans, you will not be eligible for a workout. Now, Marty, I can tell you that every mortgage borrower out there is used to calling in and saying, no problem. they're hearing that you'll be getting some help. There's some kind of workout. We're just now starting to see people run out of all those options. Well, this accelerates that for FHA. And pretty soon, a lot of people that thought, okay, I'll be fine because they're going to work something out with me, are going to be told you have no option, because if you have delinquent student loans, you will not be eligible. So this will all take time, and the delinquency, you have to wait 120 days to foreclose. You have to wait for them to miss all 3 trial payments, things like this. But we will start to see this have a massive impact. Well, we are going to see increasing foreclosures from here regardless, but we will see material foreclosures in Q2 of 2026.
Yeah. And this is only residential, right? We're not even talking about commercial.
I mean, we're not even, that's what's so crazy, right? And we see that every day. Oh, this went into special servicing. This went into foreclosure. And you're getting no bid auctions, like nobody's buying. So they've done a lot of great extending and pretending. I don't know if you saw the show with Bill Moreland and Jack Farley, but if you have not, highly recommend it. He goes through the bank balance sheets. It's bank reg data as his newsletter. And oh my, did he teach young Jack some facts? But it's just on these modifications, because they changed the way you have to report the modifications now. So all the books look better than they actually are. So it's all these little tricks to make it look a little bit rosier for a little bit longer.
Should I get him on? I should probably get him on the show.
Oh, yes. He is a gem. I mean, he's a credit nerd like me. And he went through it, and that was my job, was watching credit, and I watched, people don't understand, 2006, a lot of our prime borrowers looked just fine. By 2009, they did not, because these factors of now you're not getting home price appreciation. Now you can't access for a refi, the credit market anymore. It just changes everything, but it takes some time to really show up.
Yeah. All right. Stay frosty out there, everybody. Stay aware. Make sure you follow Melody, because I think, again, I'm joking right now, but I think there's a facade on the economy right now with government issued data. I mean, obviously, the last jobs report, it looks like they're trying to clean it up at the BLS, but what the financial pundits on CNBC and others are telling you, particularly as it pertains to the strength of the middle class and the economy overall. I think if you just look at data, particularly in housing, it's becoming very obvious. Like, again, going back to the first chart, the only chart I showed in the beginning of the episode, like qualitatively, if people are searching help with mortgage, people are struggling out there. And
absolutely,
I think we're getting a triple whammy. And obviously this AI build out is pushing up electricity prices in a lot of places. I don't think that's another thing that is being swept under the rug by mainstream pundits and the administration, is the average cost per kilowatt hour, price per kilowatt hour of electricity in major U.S. cities is approaching 20 cents, which is insane. And energy is the raw input of everything we do in the economy.
Absolutely. It's happened to us here in Tennessee. I mean, just shot up overnight. I mean, and again, we didn't even really talk about that. The taxes, insurance, and your electricity bills. I mean, and this is another headache for landlords, obviously. So it's nuts.
Well, we should do this again at some point.
Absolutely. Well, thank you so much.
In a few months, or maybe at the beginning of next year, and see where things are. Yeah. Where can anybody who's so inclined find out more about your work and what you're doing?
If I haven't depressed them to death, right? M3_Melody on X Twitter, M3 Melody Substack, and M3 Melody YouTube.
Awesome. Well, Melody, thank you for joining us today, and thank you for the incredible work. And like I said, hopefully we do this again at some point next year.
Hopefully, absolutely. And thank you for having me. It's been my pleasure.
All right. Peace and love, freaks. Okay. Thank you for listening to this episode of TFTC. If you've made it this far, I imagine you got some value out of the episode. If so, please share it far and wide with your friends and family. We're looking to get the word out there. Also, wherever you're listening, whether that's YouTube, Apple, Spotify, make sure you like and subscribe to the show. And if you can leave a rating on the podcasting platforms, that goes a long way. Last but not least, if you want to get these episodes a day early and ad-free, make sure you download the Fountain podcasting app. You can go to fountain.fm to find that. $5 a month gets you every episode a day early, ad-free, helps the show, gives you incredible value. So please consider subscribing via Fountain as well. Thank you for your time, and until next time.
Okay.